Open up your 401k or your brokerage account for the first time, and you'll usually see something like this: a list of 200, 300, sometimes even 1,000 different funds to choose from. And that list alone is enough to make most people close the tab and do nothing for another 6 months. Here's the thing nobody tells you: you don't need 200 funds. You need 3. My name's Sammy, and today we're building an actual portfolio, start to finish, in about 15 minutes, using exactly 3 funds that cover almost everything you actually need. If you caught the last video about the right order to fund your accounts, this is exactly what goes inside them once they're set up. So stick around. And if this is your first time here, go ahead and subscribe so you don't miss what we build on top of this. Let's talk about why this works, because it sounds almost too simple to be real. The entire investable world, every publicly traded company on Earth, basically breaks down into 3 buckets: US stocks, international stocks, and bonds. A single fund can hold every US company in one purchase. Another single fund can hold every major international company in one purchase. And a third can hold a broad slice of the bond market in one purchase. Once you own those 3 funds, you own a piece of thousands of companies across the entire globe, plus a cushion of bonds, all without picking a single individual stock or trying to guess which sector is going to do well this year. Compare that to the alternative, where you're trying to research individual companies one at a time, reading earnings reports, guessing which industry is about to have a good decade. That approach can work for people who genuinely enjoy it as a hobby and have the time to do it properly, but it's not what most people need to actually build wealth, and it's definitely not a requirement to get started. The 3-fund approach isn't a shortcut version of investing. For most people, it's the actual destination, not a placeholder until you get more serious about it later. You remember Jordan from the last video? The one who finally figured out the right order to fund a 401k and a Roth IRA? Well, the accounts are open, the automatic transfers are running, and Jordan just logged in to actually pick something and froze. Hundreds of fund names, ticker symbols, category labels that don't mean anything without research. That's exactly the moment we're solving today, because the answer isn't more research, it's 3 specific funds. Jordan doesn't need to become an amateur analyst to get this right. Nobody does. The version of investing that actually works for most people is boring on purpose, and that's the whole point of what we're building today. Fund 1 is a total US stock market index fund. This single fund owns a small slice of basically every publicly traded company in the United States, thousands of them, from the largest household names down to small companies you never heard of. It's the core of the whole portfolio, because historically, the US stock market has been the biggest single driver of long-term growth for a diversified investor. And owning the total market means you're never betting on any one company. You're betting on the market as a whole moving upward over time. If one company inside that fund has a terrible year or even goes out of business entirely, it barely moves the needle because it's one tiny piece of thousands. That's the actual advantage over picking individual stocks. You don't need to be right about any single company. You just need the overall market to keep growing the way it has, on average, over long stretches of time. Fund 2 is a total international stock market index fund, and this is the one people skip most often, usually because it's the one they've heard of least. Here's why it matters. The US is a huge chunk of the global economy, but it's not the entire global economy. And if you only own US companies, you're betting everything on one country's economic future. A total international fund gives you exposure to major economies outside the US in one purchase. So if the US has a rough decade, your entire portfolio isn't riding on that alone. This isn't a hypothetical either. There have been entire decade-long stretches where international markets outperformed the US, and other stretches where the US clearly led. Nobody knows in advance which decade you're about to live through, and owning both means you don't have to guess correctly to still come out ahead over the long run in the long run. Fund 3 is a total bond market index fund, and this is the one younger investors are most tempted to skip entirely because bonds have a reputation for being boring and low growth. And they are lower growth, that's true, but that's exactly their job. bonds tend to hold steadier when stocks drop sharply, which means even a small allocation to bonds can smooth out the ride enough that you're less likely to panic and sell your stocks at the worst possible moment. You're not holding bonds to get rich. You're holding them so you actually stay invested through the years stocks have a bad run. Here's the honest math on why this matters more than it sounds like it should. The single biggest threat to most people's long-term returns isn't picking the wrong fund. It's selling everything in a panic during a sharp downturn and never getting back in before the recovery happens. A portfolio that's a little bit steadier because of that bond cushion is a portfolio you're actually more likely to stick with for the next 20 or 30 years, and sticking with it is what makes the whole thing work.
So how do you decide how much goes into each of the three? There's a simple heuristic that's held up well over time. Subtract your age from around 110, and that's roughly the percentage you put into stocks combined, split between the US and international funds, with the rest going into bonds. If you're 25, that's about 85% stocks, 15% bonds. If you're 45, that shifts closer to 65% stocks, 35% bonds. It's not a perfect formula, and there's room to adjust based on your own risk tolerance, but it gives you an actual starting number instead of staring at a blank allocation screen wondering where to even begin. And within that stock portion, a common approach is to keep roughly 2/3 in the US fund and 1/3 in the international fund, which mirrors how much of the global stock market each region actually represents. You can adjust that ratio too, but it's a reasonable, well-tested starting point if you don't have a strong reason to deviate from it. One number matters more than almost anything else when you're picking between similar funds, and it's the expense ratio, the small annual fee the fund charges just for holding it. A fund charging 1% a year sounds tiny, but over 30 years, that difference can quietly eat tens of thousands of dollars compared to a fund charging a tenth of that. The funds we're talking about today, the broad total market index funds, are typically some of the cheapest options available, often under 0.1%. And that low cost is a feature, not a downside. You're not paying for someone to guess which stocks will win. You're just buying the whole market as cheaply as possible and letting it do the work. To put real numbers on it, on a $100,000 portfolio, the difference between a 1% fee and a 0.1% is roughly $900 a year, every single year, whether the market goes up or down. That's not a one-time cost. It compounds against you for as long as you hold the fund, which is exactly why it's worth 30 seconds to check before you buy anything.
Let's look at how this actually plays out for Jordan. At 30 years old, that 110 heuristic puts Jordan around 80% stocks, 20% bonds. Jordan splits that 80% roughly 2/3 into the total US stock fund and 1/3 into the total international fund, then puts the remaining 20% into the total bond fund. 3 funds, one simple split, set up once inside the Roth IRA from the last video in about 15 minutes total, exactly the way we said it would take. No spreadsheets, no research rabbit hole, just 3 purchases and done. Once it's set up, Jordan's plan is simply to keep the automatic contributions running and check the account maybe once or twice a year, not to log in daily watching the balance move. That's not neglect, that's actually the strategy working as intended.
Let's cover the mistakes that trip people up here, because I see the same handful constantly. The first is chasing whatever fund performed best last year, which almost never predicts what performs best next year, and usually just means buying in after the run-up already happened. The second is overcomplicating this with 10 or 15 different funds that all overlap heavily with each other, which adds complexity without adding real diversification. The third is skipping the international fund entirely because it feels unfamiliar, which quietly concentrates your entire future on one country's economy. The fourth is treating bonds as pointless in your 20s and 30s, when their real job isn't growth, it's keeping you invested during the year's stock struggle. And the fifth is checking your portfolio daily and panic selling the first time it drops, which turns a normal, expected dip into a permanent, locked-in loss. A sixth mistake, and this one catches people who did everything else right, is picking the 3 funds correctly, but then never actually automating the contributions. So the whole plan quietly depends on remembering to log in and invest manually every single month. The funds only work if money is actually reaching them consistently.
the same automation principle that's shown up in every video in this series so far. There's one more thing worth mentioning before we wrap up, because it comes up constantly in the comments on videos like this. Some brokerages offer a single all-in-one fund that automatically holds the same US, international, and bond mix in one purchase, adjusting the split for you as you age. If managing 3 separate funds and rebalancing them yourself feels like more than you want to deal with, one of these all-in-one options can get you a similar result with even less effort, at the cost of slightly less control over your exact split. Neither approach is wrong. 3 separate funds gives you more control and, in some cases, slightly lower fees. A single all-in-one fund trades a little of that control for genuine simplicity. Pick whichever one you're actually going to stick with for the next several decades, because consistency matters more here than optimizing the split down to the last percentage point. So here's the whole thing laid out one more time. Pick a total US stock market fund, a total international stock market fund, and a total bond market fund. Split them using your age as a rough guide. Roughly 110 minus your age in stocks, the rest in bonds. Keep the expense ratios low. Set it up once and leave it alone. That's genuinely most of what a portfolio needs to be. It's worth sitting with how different this is from what most people picture when they imagine investing. No trading screens open all day, no reacting to headlines, no feeling like you need a finance degree to get started. 3 funds, a simple age-based split, low fees, and time. The people who build real wealth this way aren't the ones who found some clever trick everyone else missed. They're the ones who picked something reasonable early, kept adding to it automatically, and left it alone long enough for the math to actually work in their favor. If this made picking your first investments feel less overwhelming, hit subscribe, because next we're covering what to actually do the first time you watch this portfolio drop, so a normal market dip doesn't turn into a panic decision you regret.